The Bank of England, established in 1694, is the first institutional model to assume the tasks of managing financial crises, controlling the money supply, and organizing government borrowing, thereby laying the foundation for modern central banking. Since the 19th century, central banks worldwide have followed and emulated it. In this video, we will learn about this institution and its contributions to banking as detailed in our book A History of Banks. If you want to learn more about financial history, please subscribe to my YouTube channel. In England, where the Anglican Church was institutionalized in the second half of the 16th century, Catholic James II ascended the throne in 1685. The return of a Catholic monarch shook the country. The king's pro-Catholic policies increased discontent in the country. Nevertheless, the fact that the heir to the throne, Anglican Mary, was married to William of Orange, Prince of Orange in the Netherlands, offered a glimmer of hope. However, things changed. James II had a Catholic son who became the heir to the throne. The Parliament and the aristocracy were displeased with this situation. Everything was decided at a secret meeting held in a country estate near London in June 1688. At the meeting, 7 leading aristocrats signed an invitation letter to be sent to Prince William of Orange. Prince William and his wife Mary were invited to ascend the English throne. This initiative would go down in history as the Immortal Seven. When Prince William arrived on the island, James II was forced to flee. The new King William III and his wife, Mary II, ruled England together. This was later combined with the Bill of Rights, a contract between the king and Parliament. This established Parliament's supremacy over the monarchy through peaceful means, and the king could no longer suspend laws passed by Parliament. This series of significant events is generally known as the Glorious Revolution or the Bloodless Revolution. In the following years, the influence of the monarchy began to decline while the power of Parliament grew. There was an increasing need for a modern economy capable of providing stable resources in England, as the expansion of the empire required financing. While banknotes issued by goldsmith bankers, previously known as goldsmiths, in exchange for gold partially met this need, it was insufficient. While funding the treasury, the goldsmiths also engaged in a wide range of banking activities. They purchased gold for their customers, exchanged foreign currency, and discounted bills. Although goldsmiths gradually increased the circulation speed of banknotes, there was a limit to the number of banknotes they could issue. The Bank of England, established in 1694, helped address the liquidity gap. The Bank of England was established to manage the government's massive debts. The bank was established as a public-private partnership, and individuals and companies could purchase shares in it. The Bank of England can be compared to the Amsterdam Bank, which was established nearly a century earlier. The Amsterdam Stock Exchange was primarily a deposit bank that facilitated payments between merchants using a stable currency, thereby preventing the chaos caused by the use of multiple different currencies. The Bank of England was primarily an issuing bank that printed paper money to meet the need for more money and to enable the government to use the limited amount of silver and gold coins available for necessary war expenditures. The bank accepted and discounted bills issued by the Treasury. It received deposits and issued negotiable instruments. It engaged in bullion trade. From the outset, it discounted exchange bills. It initially operated as a private bank established to lend money to the government. The bank faced severe difficulties in its early years. The public approached the idea of paper money, and a paper banking system, which was outside the gold-silver-based system they were accustomed to, with caution. Trust in the banknotes issued by the bank was initially limited. Many people still preferred gold and silver coins. Additionally, during the coinage reform of 1696, a severe cash shortage occurred during the reminting of coins. Gold and silver liquidity had decreased. This crisis nearly led to the bank's collapse. The bank was forced to suspend some payments. On the other hand, the government's ability to repay its debts was not reassuring. England was already heavily indebted due to wars. This increased the Bank of England's risk. Despite these challenges, it overcame them over time and became one of the world's strongest banks by the end of the 18th century. However, during this period, the role of a central bank as we know it today had not yet fully emerged. The tasks and functions it undertook in the 18th century can be summarized as follows. 1. Providing credit to the Treasury, manager of public debt. 2. Issuing banknotes, paper money. 3. Providing liquidity and crisis management. 4. Managing gold and silver reserves. 5. Payment system and clearing services. In 1797, during the Napoleonic Wars, gold panics occurred in England. The public began to redeem banknotes for gold in large numbers, and the Bank of England suspended its obligation to pay gold in exchange for the banknotes it had issued. This event paved the way for Bank of England banknotes to become legal tender in practice. In the 19th century, the Bank of England began to transform into a central bank in the modern sense. During this period, it ceased to be merely a tool for government borrowing or a commercial bank. It evolved into an institution that guided the economy, ensured the stability of the financial system, and implemented monetary policy. In its second century, it had new roles and transformations. The 1844 Peel Act legally strengthened the Bank of England's monopoly on currency issuance, and its banknotes effectively became national currency. This act limited the money supply to the gold reserve. Due to crises in the 19th century, the Bank of England began providing emergency loans to other banks and financial institutions to prevent the collapse of the financial system. This role is considered the birth of the lender of last resort function. In 1821, England officially adopted the gold standard. The Bank of England was required to hold gold reserves for every banknote it issued. The primary objective of monetary policy was to maintain the sterling at a fixed value against gold. London became the world's financial center in the 19th century. The Bank of England regulated the payment and exchange systems for both domestic and international trade. The relationship between the British Treasury and the Bank of England grew closer. The bank played an active role in government borrowing. It also collaborated with the government in matters such as setting interest rates. The bank began to exercise indirect control over the London market. It influenced the reserve policies of commercial banks. Through interventions in interest rates and money supply, it maintained market balance. As a result, by the 19th century, the Bank of England had become one of the foundational institutions of modern central banking. By the end of this century, London had become the global financial center, and the Bank of England was at the heart of this system. You can find more information in our history of banks. Enjoy your reading and don't forget to like, comment, and subscribe.